Have you ever, actually stopped to think about what happens when you drop your car off at the mechanic for a dead battery?
Oh, I'm guessing most people definitely do not.
Right. I mean, you hand over this incredibly heavy, dirty plastic box, you pay your replacement fee, and then you just drive away.
Yeah, out of sight, out of mind.
Exactly. There's this unspoken assumption we all just have that the old battery vanishes. Like it just gets thrown in a bin somewhere and it's suddenly no longer your problem.
But it definitely doesn't vanish.
No, it really doesn't. That piece of plastic and lead that you just left sitting on the garage floor is actually the starting point of this massive, highly complex, and honestly almost completely hidden global supply chain.
hmm And it is a massive chain.
So our mission for this deep dive is to essentially trace where that box goes. We're going to explore the actual mechanics of the global recycling machinery.
And we have a really fascinating case study for this today.
We do. We're doing it through the lens of one of its most intriguing kind of under-the-radar players, Gravita India Ltd.
Yeah, it's such a fascinating ecosystem to unpack. When you look at the massive stack of research we have on the table today, the very first thing that becomes incredibly clear is that this is not, some feel-good story about saving the Earth.
Right. This isn't Captain Planet.
Exactly. We aren't looking at a purely environmental crusade here. This is a hardcore industrial reality. So Gravita started back in 1992 in Jaipur.
Okay.
And over the last 3 decades, they have just quietly built this global empire by doing basically one thing exceptionally well, which is turning industrial trash into high-value raw materials.
Right.
I mean, the global shift away from primary mining, pulling fresh ore out of the ground toward this circular economy, it's not just some corporate buzzword anymore.
No, it's becoming the law.
Exactly. It is a structural, permanent shift,
Yeah.
and it's currently being strictly enforced by government mandates all over the world.
Yeah, the governments of the world are basically forcing this entire industry into existence. And the scale of what we are going to look at today is just staggering. But we're going to try to break it down logically for you.
That's a good idea. There's a lot of ground to cover.
So first, we're going to start by mapping out the physical reality of how Gravita actually makes its money, like how they operate this sprawling international network just to collect your old scrap. Then we're going to look at this massive paradox right at the heart of their business. They basically rely on lead for 88% of their revenue.
Which sounds crazy right now.
Right in the middle of a massive global push toward lithium-ion electric vehicles. We'll explore how government regulations are essentially handing them a monopoly on a silver platter.
A literal legal moat.
Yeah, exactly. Then we'll look at their attempts to branch out into things like aluminum and plastics. And finally, we'll kind of strip away the polished corporate exterior to examine the very real geographical risks and the governance red flags hiding in their boardroom.
Because, as with any industrial operation of this size, looking at just the revenue growth only gives you half the picture.
Right.
The real mechanics of their competitive advantage and, frankly, their biggest vulnerabilities are buried deep in how they manage these supply chains across emerging markets.
Yeah.
And also how the people at the top are actually incentivized to run the machine.
So let's start right at the foundation then. Before we can talk about where Gravita is heading over the next decade, we really need to understand the basic mechanics of what happens on their factory floor today.
Yeah, we have to move away from the abstract idea of, recycling and look at the hard reality of how cash actually flows into this business.
Right, because based on the sources, their operational footprint is just vast. I mean, they aren't just sitting in India waiting for scrap to miraculously arrive at their door.
No, not at all.
They operate this procurement network with over 1,900 touch points spread across 5 continents.
It's massive.
They're buying scrap lead, aluminum, plastics, waste tires, processing and refining all of it in their own facilities, and then turning around and selling the refined raw material back to massive industrial manufacturers in over 50 countries.
And that geographic spread, that is the absolute core of their model. To really understand what a touch point is, you have to picture the ground reality here.
Okay, paint me a picture.
Well, these aren't just shiny, air-conditioned corporate offices. A touch point involves local scrap aggregators, independent haulers, and regional collection centers.
So like the guy with a truck buying scrap from the local mechanic.
Exactly that guy. And by maintaining 1,900 of these nodes globally, Gravita is effectively arbitraging the world's waste.
Arbitraging waste, I like that.
Yeah, they were actively hunting for pockets around the globe, very often in developing markets in Africa or Latin America, where scrap is incredibly cheap. And it's plentiful because there's just no local capacity to process it.
Ah, so there's no one else there buying it up.
Right. So they collect it there, they run it through their own highly efficient smelters, and then they sell that finished product to buyers in highly regulated developed markets.
The ones who demand incredibly strict material specifications.
Precisely.
Now, I did find a detail in the research that completely surprised me, though. It turns out Gravita doesn't just recycle scrap themselves.
Oh, the turnkey stuff.
Yeah. They also build recycling plants for other people. The sources call them turnkey projects.
Hmm.
They've apparently delivered over 57 of these turnkey plants in more than 40 different countries, meaning they engineer the plant, they supply the equipment, they install it, and then they literally hand over the keys to someone else.
Right.
When I first read that, it seemed completely counterintuitive. I mean, why would a company that makes its money processing scrap actively arm potential competitors with their own proprietary blueprint?
Yeah, I totally see why it looks like they're just creating their own competition. But if you look a bit closer at the strategy, it actually solves a very specific operational problem for them.
Really? How so?
Well, building and running a heavy industrial smelter, it requires a massive amount of capital. And it exposes you to huge operational risks, especially if you are trying to operate in a politically unstable region.
Okay, that makes sense.
So by providing these turnkey solutions to local operators, Gravit creates a really lucrative secondary revenue stream. They get paid to build it. But more importantly, they basically embed themselves into the global recycling ecosystem.
Oh, I see.
Yeah, when you build the plant, you establish the technical standards for that entire region.
Ah, so they set the baseline.
Exactly. It allows them to monetize their engineering expertise, their intellectual property, basically in countries where they simply don't want to risk deploying their own capital or, deal with the massive headaches of managing a local workforce.
So it's essentially a way to profit off a region without actually having to put their own boots on the ground long term.
Exactly.
That makes a lot of sense. Now let's talk about the financial scale of the operation they do run themselves. For the financial year 2025, the research says Gravita pulled in 3,191 crore rupees in revenue.
Which is a very healthy top line.
Yeah, and to put that in perspective, we're talking about a highly tuned, highly efficient engine. And the way they actually price their product is fascinating to me.
The pass-through model.
Yeah, they essentially pass the global commodity price straight through to their buyers, but then they charge this 10% to 15% premium specifically for the processing and refinement work they do.
And that pass-through mechanism is the absolute lifeblood of their unit economics. I mean, they are not out there trying to play the commodities market.
Right, they aren't speculators.
Exactly. They aren't sitting around taking directional bets on whether the price of lead or aluminum is going to spike or crash next month on the London Metal Exchange.
Because that would be incredibly risky.
Right. So they insulate their profit margin from that underlying volatility by locking in their processing spread.
Okay, walk me through how that actually works mechanically.
Sure. Mechanically, they source the raw scrap at a really steep discount to the global benchmark. Usually they pay around 70% to 80% of the market price.
Okay, cheap inputs.
Then they run that scrap through their smelters. And over the years, they have refined their technology to achieve incredibly high yield efficiencies. We're talking 95% to 98%, meaning very little of the material actually goes to waste.
Wow, that is efficient.
Yeah. And then finally, they sell the finished purified metal at the global market price, plus their processing premium.
Okay, let me try to frame this to see if I'm fully grasping the model here. It sounds to me like Gravita is basically a toll booth.
Okay, listen.
Like they aren't betting on the value of the cars driving on the highway. They are just the toll booth sitting halfway between the junkyard and the manufacturing plant. And they just take a steady, predictable cut for cleaning up the wreckage as it passes through their gate. Is that a fair way to look at it?
I'd actually push back on the toll booth analogy just a little bit.
Oh, really?
Only because a toll booth just lifts a gate and lets you pass. Right.
Huh.
Gravita is fundamentally altering the chemical and physical state of the material. It's highly technical work.
Fair point, yeah.
But your underlying point about their financial positioning is spot on. They are a volume-driven processor.
Right.
And because their facilities operate with roughly 60% fixed costs and 40% variable costs, every incremental ton of scrap they manage to push through their system drops a massive amount of profit straight down to the bottom line.
Because the factory is already paid for, essentially.
Exactly. This asset-light, high-turnover approach is precisely what allows them to generate a 24% to 28% return on the capital they invest. I mean, they are turning their working capital incredibly fast.
Yeah.
Their cash conversion cycle is roughly 30 days.
Wait, 30 days, meaning they buy the scrap, process it, sell it, and get cash back in the bank in just a month.
Yes.
Doing that across 50 countries is just a logistical marathon. I can't even imagine the paperwork.
Oh, it's intense.
But now that we understand how they process the materials, we need to look at what they're actually processing. And honestly, this was the most jarring statistic in the entire stack of research we looked at.
The lead numbers.
Yeah, we live in an era where literally every single automotive headline is about lithium, cobalt, nickel, and the electric vehicle revolution.
Right.
Yet, a staggering 88% of Gravita's massive revenue comes from lead recycling.
It is the ultimate industrial paradox of our current cycle. I mean, when most people hear the word lead, they just assume it's this toxic relic of the 20th century.
Right, like lead paint or leaded gasoline.
Exactly. Something tied exclusively to old internal combustion engines that is being rapidly, permanently phased out. But the physical reality of automotive engineering is far more complex than that. And Gravita has built their entire foundation on the world's misunderstanding of how vehicles actually work.
See, I have to play the skeptic here because my very first thought reading that was, this company is doomed.
You wouldn't be the only one to think that.
I mean, if the entire globe is rapidly transitioning to lithium-ion EVs and governments are literally banning the sale of gas-powered cars in the coming decades, how do you justify having 88% of your revenue tied to the old, heavy, lead-acid batteries? Doesn't that mean their core product is headed straight for a museum?
That is the perfectly logical assumption to make. But it completely ignores how an electric vehicle is fundamentally wired.
Okay, educate me.
The EV revolution does not eliminate the need for lead. It's true that the massive, high-voltage lithium-ion pack, the ones sitting under the floorboards of an EV, that's what provides the propulsion. It actually turns the wheels and moves the heavy car.
Right, the thing that gives you the range.
Yeah, but every single EV on the road today still requires a traditional 12-volt lead-acid battery to run its auxiliary power systems.
Wait, really? Even a brand new top-of-the-line EV has a standard lead battery hiding somewhere under the hood.
Absolutely. Almost all of them do.
But why? If they have this massive super battery in the floor, why do they need a clunky lead battery?
Because the lithium-ion pack is designed for massive bursts of energy, like accelerating a 2-ton car onto a highway. But lithium chemistry is incredibly sensitive to what engineers call parasitic drains.
Parasitic drains.
Yeah, so if a lithium battery is slowly drained down to absolute zero by small, constant power draws, it can permanently break the entire battery pack, ruin it completely.
Oh, wow. That would be an expensive mistake.
Exactly. So automakers use a cheap, incredibly robust lead-acid battery to handle all the low-level, constant electrical needs.
Like what kind of needs?
Like the onboard computers, the automatic locks, the headlights, the alarm system, even the safety sensors that need to stay active while the car is parked in your garage. Lead-acid handles those constant low-level power drains perfectly, and crucially, it's incredibly cheap to replace.
That is fascinating. So because of this dual battery architecture, the global demand for lead-acid batteries isn't actually dying at all.
Not at all. Industry projections show it remaining remarkably stable, with the world requiring roughly 30 to 35 core units annually, all the way through 2030 and beyond.
Wow. That completely changes the narrative. I mean, the shiny, futuristic propulsion tech actually requires the reliable, century-old brute force of lead just to keep the dashboard computers from dying.
Pretty much.
So the sandbox Gravita is playing in is actually incredibly secure. Let's look at the sheer size of that sandbox. According to the research, the global lead market is an absolute beast.
Oh, it's huge.
We're talking about a total market of 1.1 to 1.2 crore metric tons annually. And secondary lead, which is the recycled portion that Gravita deals in, makes up roughly half of that, so about 55 to 65 lakh tons.
Yeah, and if you convert that physical volume into dollars, the global secondary lead market is worth roughly $5,000 to $6,500 core dollars every single year.
That's incredible.
It's a massive, deeply entrenched market.
Yeah.
Now, you have to ask, where does Gravita fit into that global pot?
Like, how much do they own?
Currently, their total installed capacity is 1.74 lakh metric tons. So on a purely global scale, they hold a relatively small sliver, about 2.5% to 3% of the world's secondary market capacity.
Okay, so a tiny piece of a huge pie.
Yes, globally. However, when you zoom in on their domestic market in India, it's a completely different story. They hold a dominant 15% to 25% share of the formalized Indian market.
Okay, so they are a massive fish in the Indian pond, but a fairly small player globally.
Right.
But here's what I'm really trying to square here. The research also clearly states that the global lead market is only growing at about 2% to 3% annually. It's basically flat.
Right. It's very mature.
So if the overall pie is barely expanding, how does a company like Gravita generate the kind of aggressive growth numbers their investors expect? You can't be a growth stock in a 2% market, can you?
Well, that slow growth rate
Mm.
is exactly why lead is their cash cow, not their long-term growth engine.
Okay.
A mature, highly predictable, slow-growing segment is exactly what you want as the foundation of a heavy industrial business. It generates the consistent, predictable cash flow that's required to fund their riskier high-growth bets in other materials.
So it pays the bills for the experimental stuff?
Exactly. They don't need the global demand for lead to suddenly spike by 20% a year. They just need the market to remain stable, because Gravita's real volume growth isn't actually coming from a sudden surge in the world needing more lead.
Then where is it coming from?
It is coming from a massive structural shift in how the existing lead is collected. It's coming from regulatory enforcement.
And that leads us right into the most fascinating part of this company's strategy.
Yeah.
Because since the global market is barely growing, the only way Gravita can expand its processing volumes is by taking market share away from someone else.
Exactly. It's a zero-sum game in that sense.
And the way they are doing that isn't by inventing some breakthrough new smelting technology that makes them 10x better. They are doing it with government paperwork.
Yeah, quite literally.
It is regulatory policy weaponizing the recycling industry in their favor. To understand this, we have to talk about the shadow economy.
The informal sector.
Right. In developing markets, the research notes that a massive 30% to 40% of lead recycling is still done informally.
Yes, and the informal sector has historically been the biggest thorn in the side of organized recyclers like Gravita. When we say informal, we are talking about highly unregulated, heavily polluting backyard operations.
Like literally in someone's backyard.
Yes, these are local scrap dealers who manually break open batteries with axes. They drain the highly toxic sulfuric acid directly into the soil or local waterways, and then they melt the lead down in crude open-air furnaces.
That sounds horrific for the environment.
It's awful. And for decades, Gravita had to try and compete against these shadow players, and it was nearly impossible.
Why? Because the informal guys were cheaper.
Exactly. The informal operators had zero compliance costs. They paid no taxes, didn't provide safety gear to workers, and completely externalized all the environmental damage. So they could always afford to pay the local mechanic a few rupees more for a dead battery than Gravita could.
Wow, so they were just getting outbid for the scrap by people who didn't follow the rules. But that entire dynamic is ending violently right now, because the regulatory tailwind sweeping across the globe is massive. The sources point to two major pieces of legislation as prime examples: the 2022 Battery Waste Management Rules in India and the new European Union battery regulation.
All of which are game changers.
Completely. And at the center of both of these laws is a concept called extended producer responsibility, or EPR. And I really want to make sure you, the listener, grasp this concept, because EPR fundamentally rewrites the rules of industrial manufacturing.
It absolutely does.
Yeah.
Extended producer responsibility means that the original manufacturer of a product, so in this case the battery brand itself, is now legally responsible for the entire life cycle of that product,
All the way to the end.
all the way through to its final disposal and recycling. Historically, a company like Exide or Amara Raja could just manufacture a battery, sell it to a distributor, and wash their hands of it. Once it was sold, it simply wasn't their problem.
Right, but EPR makes it their problem. And it's not a loose guideline. It's a strict mandate. The EU, for example, is demanding that manufacturers prove a 90% lid recovery rate by the year 2030.
That is a very high bar.
It is. And in India, the new battery waste management rules mandate strict, formalized material recovery pathways. The big battery brands can no longer just look the other way when local scrap dealers buy their old units.
They literally can't afford to.
Right. The government is forcing the brands to produce a detailed certified audit trail proving that their batteries are being recycled by fully compliant, environmentally safe facilities.
And that audit requirement is what destroys the informal sector's business model overnight. I mean, a backyard smelter dumping acid in a river simply cannot provide a recognized environmental compliance certificate to a massive global battery brand.
It's like a massive game of musical chairs, but instead of the music stopping, the government just suddenly kicked all the informal players out of the room.
That's a great way to look at it.
I mean, the local scrap dealers are still out there, But suddenly the big buyers, the battery manufacturers, are legally prohibited from buying recycled lead from them. The government is essentially mandating that the entire flow of scrap across the country be diverted away from the shadow economy and routed directly to the loading docks of organized, certified companies.
Which is exactly where Gravita has built its moat.
Right.
Gravita has spent decades and millions of rupees building up their environmental certifications, their pan-India collection networks, and their compliance tracking software. They already have the EPR framework built into their day-to-day operations.
So they are ready to go.
Exactly. So when the laws change, they just become the default, legally mandated destination for all this newly formalized scrap.
And it locks out new competitors too, right?
Absolutely. If a new player wanted to enter the market today and try to compete, the barrier to entry isn't just building a smelter. It's having to replicate 3 decades of compliance infrastructure across an entire continent. It's incredibly difficult to do from scratch.
And what's brilliant is that they aren't just letting this happen in India. Gravita is actively replicating this exact strategy across the African continent.
Yeah, their Africa play is really interesting.
According to the research, they have established a massive footprint in countries like Senegal, Togo, Tanzania, Mozambique, and Ghana. Now, at first glance, expanding heavily into West and East Africa seems incredibly risky.
It does.
But when you look through the lens of EPR, it makes perfect sense. Africa right now looks a lot like India did 15 years ago. They completely lack a formal, organized battery collection infrastructure.
And moving into the African market early is a strategic masterstroke by management. By establishing their collection yards and processing facilities in these countries before the regulatory hammer inevitably falls, Gravita is positioning itself as the foundational recycling infrastructure for the entire continent.
Wow, getting it on the ground floor.
Exactly. Environmental regulation is a global trend. As these African nations begin to adopt their own formalization mandates to curb pollution, Gravita will already be on the ground, fully operational, and completely ready to capture the mandated flow of scrap.
And the research actually gives a number to this. It estimates that this early mover advantage in Africa provides Gravita with an 8% to 12% annual growth potential simply by formalizing these totally untapped regions.
Yeah, they're building the relationships with the local aggregators and securing the scrap at the source before any major international competitors even have a chance to bid on it.
Okay, so we've firmly established that the lead business is this incredibly stable cash generator. It's heavily protected by a widening regulatory moat, and it's expanding geographically.
Right.
But Gravita's management team is smart enough to know they can't rely on a market that's only growing 2% globally forever.
No, eventually they hit a ceiling.
Right. So their corporate strategy, which they call Vision 2029, is explicitly clear on this point. They aim to push their non-lead revenues to over 30% of their total business by the end of the decade.
Which is a big pivot.
Huge. They know they have to diversify. So let's look at what they're building beyond lead. The biggest target on their radar is aluminum.
Oh, aluminum is huge right now.
Yeah, the total addressable market for secondary aluminum is staggering. We are talking about a 5,000 to 6,000 crore dollar market globally. But why is recycled aluminum suddenly such a massive growth vector right now?
It brings us right back to electric vehicles.
Exactly. But this time, it's not about the auxiliary battery. It's about the weight problem.
The lightweighting trend in automotive engineering is the single biggest catalyst for the aluminum market right now.
How so?
Well, if you look at a traditional internal combustion engine vehicle, it uses roughly 120 kilograms of aluminum throughout its chassis and engine block. But an EV has a completely different weight profile. It is bogged down by that massive, incredibly dense lithium-ion battery pack we talked about earlier. Those battery packs can weigh thousands of pounds.
They are insanely heavy.
Yeah, so if you put that much weight on a standard steel chassis, the car would be incredibly sluggish, and more importantly, the battery range would absolutely plummet.
Which is the one thing EV drivers care about.
Exactly. So to offset the weight of the battery and maintain an acceptable driving range, auto manufacturers are being forced to aggressively lightweight the rest of the vehicle.
Which means replacing heavy steel parts with lighter aluminum parts.
Exactly.
And the numbers bear this out perfectly. The research notes that while a gas car uses 120 kilos, an EV requires between 180 and 220 kilograms of aluminum, We are talking about nearly double the aluminum per vehicle.
It's a massive increase in demand per unit.
And when you look at the macro projections, global EV production is expected to jump from roughly 1.4 crore units being built today to an estimated 4 to 5 crore units annually by the year 2030.
That is a lot of cars.
It is. That means there is an absolute tsunami of aluminum scrap coming to the global market as these early EV fleets eventually start crashing or reaching their end of life.
And there is a massive economic incentive to recycle that aluminum rather than mine more of it.
Why is that?
Well, unlike lead, which has a relatively steady energy profile, the energy arbitrage in aluminum is extreme. It requires roughly 95% less energy to melt down and recycle existing aluminum scrap than it does to mine raw bauxite ore out of the ground, transport it, and smelt it into primary aluminum.
95% less energy. That is wild.
Yeah. So as global energy costs continue to rise, the cost advantage of producing recycled aluminum over primary aluminum widens significantly.
So this becomes more and more profitable to recycle it.
Right. And Gravita is aggressively positioning themselves to capture this margin expansion. Right now, they hold less than 1% of the global secondary aluminum market.
Less than 1%.
Yeah, which means the runway for growth in this specific vertical is practically limitless, assuming they can secure the scrap.
And they're also making aggressive moves into two other major waste streams, plastics and tires. And honestly, the statistics on global plastic production are, frankly, depressing to read.
Yeah, the plastic numbers are grim.
We are looking at a 40 crore ton global production monster every single year, and out of that mountain of plastic, only 3 to 4 crore tons are actually recycled.
The rest just ends up in landfills or the ocean.
The tire market is...
Think about companies like Coca-Cola, Michelin, or Nestle. These corporate giants have all made public, binding commitments to incorporate anywhere from 25% to 50% recycled content into their packaging and products by the year 2030.
And those brands can't just buy plastic flakes from a random guy in a backyard with a plastic shredder.
Definitely not.
They need food-grade, highly purified recycled plastics. They need high-quality, recovered carbon black that meets incredibly strict safety standards for new high-speed tires.
Right. And Gravita is stepping up, leveraging the exact same compliance infrastructure they built for lead to provide that fully certified, reliable supply chain for plastics and rubber.
So they're essentially copy-pasting their lead playbook into these new materials.
Exactly. It's about applying their core competency, which is formalizing messy waste streams, to new materials.
But the real wild card in their diversification strategy, the one that has all the industry watchers paying attention, is their gamble on lithium-ion battery recycling.
Oh, yeah. This is the big one.
Right now, the global lithium-ion recycling market is tiny. The research notes there is only about 2 to 3 lakh tons of processing capacity globally, but the clock is ticking very loudly.
Yeah, the wave is coming.
Because the first major wave of dead EV batteries from the early generations of Teslas and Nissan Leafs is slated to hit the scrapyards in massive numbers between 2028 and 2032.
This is undoubtedly their moonshot. I mean, Gravita isn't waiting for the wave to hit. They have already launched a dedicated lithium-ion recycling plant in Mundra, Gujarat.
Wow, they're already building it.
Yes, but we have to be really clear here. This is a highly execution-dependent gamble.
Why is it such a gamble?
Because the physics and chemistry involved in recycling a lithium-ion pack, which contains lithium, cobalt, nickel, and manganese, is exponentially more complex than simply tossing a lead battery into a smelter.
Because lithium is so volatile.
Extremely volatile. Right. You are dealing with highly dangerous, high-voltage battery packs that carry a severe fire risk. They have to be safely transported, meticulously discharged, mechanically shredded in a highly controlled environment, and then chemically separated to extract the valuable black mass containing the precious metals.
Black mass, that even sounds intimidating.
It is. It's a very difficult high-tech process.
And even if they master the complex chemistry, they're going up against a massive geopolitical headwind. Because the research points out a terrifying reality for anyone trying to enter this space. Right now, 60% to 70% of global lithium-ion recycling capacity is completely hoarded by China.
Yeah, China recognized this transition a decade ago.
Right. They subsidized the development, and they built the infrastructure while the rest of the world was basically asleep.
And that's a huge problem for new entrants. Gravita's ability to crack these incredibly complex chemistries, scale their Mundra facility efficiently, and actually compete with Chinese scale will ultimately dictate whether they truly survive the next decade of the EV transition, or if they just remain a very successful but ultimately legacy lead company.
It's a pivotal moment that raises a critical question about how management allocates their capital. I mean, scaling a competitive lithium-ion recycling operation requires intense research and development and incredibly heavy capital expenditure.
It does.
Gravita clearly has the stable, predictable cash flow from the lead business to fund this R&D, but they still have to prove they can actually execute on the technology at scale.
Because the economic prize, if they get it right, is just massive. The cost arbitrage is very real here.
What are the numbers on that?
Well, producing recycled lithium currently costs roughly $8,000 to $12,000 per metric ton, while mining and refining primary lithium costs between $12,000 and $18,000.
So it's significantly cheaper to recycle it.
Yes. If Gravita can master the chemical extraction process and drive their yields up, the profit margins will be spectacular. But we can't ignore that they are starting from a very low base. They currently hold less than 5% of the global market share in a race against deeply entrenched Chinese competitors.
Okay, so we've mapped out this massive multi-front expansion. They are securing lead in Africa, pivoting to aluminum for lightweight EVs, tackling plastics for massive corporate brands, and gambling on the complex chemistry of lithium-ion.
They are busy.
Extremely. But it's one thing to build the physical yards to collect all these different types of scrap. It's entirely another thing to ensure you don't just become a victim of the wildly fluctuating prices of the commodities themselves.
Right. Commodity risk is huge.
So how does Gravita ensure that all this effort actually results in a stable, predictable profit margin? This brings us to a strategic pivot they made that is basically magic for their margins.
The value-added products.
Yes. They realize that if you just sell basic dumb metal, you are completely at the mercy of the market. So they aren't just shipping out standard commodity ingots anymore.
And that pivot is arguably the smartest strategic decision the company has made in the last decade. They are aggressively pushing what they call value-added products, or VAPs.
How does a VAP differ from normal recycling?
Well, historically, a recycler would just melt down a batch of scrap aluminum, pour it into a generic rectangular block called an ingot, and sell it at whatever the global exchange said a block of aluminum was worth that day.
Which is a race to the bottom on price.
Exactly. It's totally commoditized.
Yeah.
Gravita realized they could escape that trap by developing highly customized alloys tailored to the exact micro-specific specifications of individual industrial manufacturers.
Okay, to make this concrete for you. A massive automaker casting engine blocks doesn't just call Gravita and say, hey, send me 10 tons of your standard aluminum.
No, they would never do that.
Right. They call Gravita and say, we need 10 tons of aluminum, but it must contain exactly 3.2% magnesium, 1.5% silicon, and less than 0.1% iron. Otherwise, our engine block will literally crack under pressure.
Precisely. And by acting as a metallurgical chemist rather than just a scrap melter, Gravita provides that exact custom formulation.
Which fundamentally changes their relationship with the buyer.
Entirely. They embed themselves deeply into the manufacturer's own R&D cycle. The manufacturer has to invest significant time, testing, and money to validate that Gravita's specific custom alloy meets their strict safety and performance standards.
And once that happens...
Once that validation happens, the manufacturer is incredibly reluctant to switch to a cheaper competitor.
Because switching means revalidating a whole new supplier from scratch, which costs time and money.
Exactly. This creates massive switching costs. Because of this lock-in and the deep technical expertise required, Gravita can command a 10% to 15% pricing premium on every ton of VAP they sell compared to just a standard ingot.
So we understand the mechanism. They do harder work to make stickier customers. But let's look at what this actually means for the numbers on the page. In 2022, these value-added products made up 42% of their total revenue. Recently, they've successfully pushed that number to 47%, and their stated Vision 2029 target is to ensure VAPs make up over half of their entire business.
Which is a great target.
And the financial impact of this shift is undeniable. Let's look at the data from the second quarter of the 2026 financial year. Gravita saw only a tiny 4% growth in the actual physical volume of scrap they processed.
So barely any more material moving through the plants.
A measly 4%. But because a larger percentage of that material was transformed into custom VAPs, they reported a massive 33% jump in actual profit.
Wow. That dynamic is the textbook definition of operating leverage through premiumization.
It really is.
By moving up the value chain, they are wringing drastically more cash out of the exact same pile of scrap. They don't need to spend millions building a massive new plant or hustle to collect 30% more batteries off the street to grow their earnings.
They just need to formulate the scrap they already have in the yard into a higher value, customized product.
Exactly. It completely changes the return profile of the business, allowing profits to grow exponentially faster than physical volumes.
It's an incredible story of operational excellence and strategic foresight. But look, no deep dive is truly complete without looking at the warning lights flashing red on the dashboard.
And there are a few big ones here.
Right. The growth story sounds practically flawless up to this point, but there are several glaring high-severity risks hidden in this research that we simply cannot ignore.
We have to look at the downsides.
And the first one takes us right back to their aggressive geographic expansion. We talked earlier about their masterstroke of moving into Africa early to capture the scrap before regulations hit.
Yes.
But that strategy is a serious game of geographic roulette.
It absolutely is, and it is a massive vulnerability that could wipe out years of profit. When we look at the bigger picture of macroeconomic stability, operating heavy industrial assets in emerging African markets carries severe geopolitical and, crucially, currency risks.
Yeah, we have seen this play out repeatedly across the continent with other multinational corporations.
The research specifically points to the collapse of the Zambian kwacha as a prime example.
Let's break down how this actually impacts the business on the ground. Gravita could be running a highly efficient, incredibly profitable smelting plant in Zambia.
Right. Everything is working perfectly.
The local managers are hitting all their targets, the scrap is flowing, and the spreadsheet says they are making an absolute fortune in local currency.
But
If the Zambian kwacha suddenly plummets in value against the US dollar or the Indian rupee or worse, if the local central bank panics and imposes strict capital controls preventing money from leaving the country, that profit is effectively an illusion.
it's trapped.
Exactly. The cash is entirely trapped offshore. They physically cannot convert it and send it back to headquarters in India to pay dividends to shareholders or, fund the expansion of their new lithium plant in Mundra.
And the risk extends far beyond just currency fluctuations.
What else is there?
Well, when you operate a physical supply chain in these developing regions, you are dealing with the constant threat of sudden political instability, unpredictable changes in export tariffs, or just sheer logistical bottlenecks.
Like what?
Imagine a scenario where a military coup happens or a sudden trade sanction is applied to a specific country. You could have millions of rupees worth of processed aluminum sitting in shipping containers at a port that lacks the modern infrastructure to move it.
Or the port is just shut down completely.
Exactly. Overnight, massive amounts of working capital can be stranded. The research specifically flags this geopolitical exposure as a high-severity risk with a potential impact window of just 6 to 18 months. It is an ever-present danger.
Then, right alongside the geopolitical risk, there is the environmental sword of Damocles hanging over their operations everywhere they operate. Let's not forget what their core business actually is.
Right, it's not a clean business.
No, we are talking about processing massive quantities of lead and sulfuric acid. It is fundamentally intensely hazardous work.
Absolutely.
One major pollution violation, an accidental spill at a facility, or a sudden, drastic government ban on lead processing in a key municipality could be totally devastating.
We are talking about the potential for massive, unplanned capital expenditures.
Yeah. The sources estimate that simply retrofitting a single existing plant to meet a suddenly stricter emission standard could cost anywhere from 5 to 10 crore rupees in unplanned costs.
And that's if they are lucky. Or worse, a local regulator could just revoke their license and shut the plant down entirely.
The irony in their business model here is just palpable. The very same strict environmental regulations like those battery waste management rules we discussed that create Gravita's incredible protective moat by forcing informal scrap into their organized facilities.
Right. Are the exact same regulations that could strangle them.
Yes. If a government decides to make enforcement overly punitive, or if the technological cost of compliance just becomes unsustainable, their margins vanish. They literally live and die by the pen of the environmental regulator in every single jurisdiction they operate.
It's a high-wire act for sure.
But the risk that really jumped off the page for me, the one that requires us to look really closely at the physical reality of their business, is this massive cash flow illusion I noticed in their recent filings.
Ah, yes. A free cash flow issue.
Let me read these numbers. In the financial year 2025, The company proudly reported a massive 362 crore rupees in net income.
Outstanding, right? It looks like they're swimming in cash.
Yeah, it looks great on the surface, but when you look past the headline profit and look at the actual cash flow statement, they generated a negative free cash flow of 19.6 crore rupees.
And that specific divergence is a classic warning sign of severe working capital strain.
Explain that for us.
When a company's reported profits are surging upward, but their actual free cash flow, the hard money entering the bank account, is negative, it tells us there is a major bottleneck in how the business operates day to day.
To put it in plain terms, it's like having a million-rupee salary written on your employment contract, but your actual checking account is overdrawn and bouncing checks because your boss is paying you in IOUs.
That's a great way to put it.
They are booking the revenue on paper because they made the sale, but they aren't actually collecting the hard cash from their buyers fast enough to offset the money they are spending to build up massive piles of scrap inventory and construct new plants.
That's the exact operational reality. This happens when the time it takes customers to pay their invoices increases, meaning the massive auto manufacturers are squeezing their suppliers and taking 60 or 90 days to pay Gravita.
Well, Gravita still has to pay cash for the scrap.
Right. At the same exact time, Gravita is aggressively buying up raw scrap to ensure their smelters stay running, so their cash is tied up in literal mountains of physical junk sitting in their yards.
And if that trend continues,
If this trend of negative free cash flow continues as they try to scale up, they will eventually be forced to go to the banks and take on higher levels of expensive debt simply to fund their day-to-day operations.
and taking on heavy debt would completely destroy that beautiful, highly efficient operational model we praised earlier.
It absolutely would.
And what makes that working capital strain even more terrifying is the commodity trap they might be walking into. We mentioned earlier that they brilliantly pass through the prices of lead to protect their margins.
Right.
And they actively hedge their physical lead inventory on the financial exchanges so they don't lose money if the price of lead drops while the scrap is sitting in their yard.
Which is smart.
It is. But the research points out a glaring omission. Their rapidly growing aluminum and plastic segments, the exact segments they're relying on for all this future growth, are currently unhedged.
This is a critical, almost baffling gap in their risk management strategy.
Right, why wouldn't they hedge it?
It's hard to say. Let's walk through a very plausible scenario, though. Say Gravita spends millions aggressively buying up aluminum scrap to hit their growth targets.
Okay, so the yards are full of aluminum.
Then, global aluminum prices suddenly crash, perhaps due to a massive, unexpected oversupply of primary aluminum flooding the market from China.
Which happens.
It does. Because they haven't hedged that risk, Gravita is suddenly left holding a massive yard full of expensive aluminum scrap that they bought at last month's high prices.
Oh no.
Suddenly, their recycled aluminum is completely uncompetitive against the new, dirt-cheap primary aluminum on the market.
So they are stuck with it.
To get rid of the inventory and actually generate cash, they would be forced to slash their prices, taking a massive loss and completely crushing the profit margins of that entire division.
Wow. The lack of hedging in these new vital growth verticals exposes them to the exact same brutal commodity volatility that they so successfully engineered out of their legacy-led business.
It's a huge blind spot.
Okay, so let's summarize the minefield they were walking through here. We have geopolitical landmines and trapped cash in Africa, existential regulatory hazards, a growing negative free cash flow problem, and massive unhedged commodity exposure in their fastest growing segments.
It's a lot to manage.
The obvious question is, who is actually sitting at the steering wheel navigating all these risks? Let's look at the humans running the machine.
The governance structure.
Right. This brings us to the governance and leadership structure of Gravita. And frankly, the contrast at the very top of this company is incredibly jarring.
It really is. When you look at the boardroom dynamics, it's a tale of two entirely different incentive structures, which naturally leads to conflicting priorities on how the company should be run.
Let's lay out the numbers. At the very top, you have the founder and chairman, Rajat Agrawal. He holds a massive 32.83% ownership stake in the company.
That is a huge chunk.
In terms of rupees, that stake is currently worth roughly 3,350 crores. He has an almost unfathomable amount of skin in the game. His entire legacy, his reputation, and his family's generational wealth are inextricably tied to the long-term, multi-decade survival and stability of this company.
He is playing the long game.
Exactly. On the exact flip side, you have the operational leader, CEO Yogesh Malhotra. He takes home a very handsome 4.73 crore rupees a year in compensation, but he holds a microscopic 0.014% equity stake in the company.
Which is basically nothing in comparison.
Right. That equity is worth just 1.42 crore rupees.
This stark contrast raises an incredibly important question about incentive alignment.
Right.
The research notes that a massive 81% of the CEO's total compensation is directly tied to performance bonuses, stock options, and variable pay.
Which means he only gets paid big if he hits short-term targets.
Exactly. You have to consider human psychology here. When a CEO's personal wealth is mostly tied to hitting strict yearly performance targets rather than holding a massive chunk of long-term equity, their psychological timeline is drastically shortened.
They only care about the next quarter.
They are heavily incentivized to chase short-term volume metrics. A CEO in that position might be tempted to, say, stuff the sales channels with lower margin product, or perhaps delay necessary expensive maintenance on a smelter just to ensure they hit their quarterly profit targets that trigger their multi-core bonus payout.
Right. The risk profiles are completely mismatched. If the CEO only owns a fraction of a percent of the company, he has virtually no exposure to the massive downside risks we just talked about.
Exactly.
If the Zambian kwacha completely collapses, or if the Mundra lithium plant turns into a massive, cash-burning money pit 5 years from now, the founder loses hundreds of crores of net worth.
And the CEO.
The CEO, at worst, just misses his annual bonus and maybe finds a new job.
And this structural misalignment between the founder and the CEO is heavily compounded by a broader transparency gap across the entire board of directors.
What's an issue with the board?
The research points out that the average tenure of the board of directors is shockingly low at just 1.7 years.
Wow, under 2 years.
Yeah, that implies an incredibly high turnover rate. It suggests that the independent directors, the people whose actual job it is to ask the hard questions, simply haven't been around long enough to deeply understand the intense intricacies of a global recycling operation spanning 50 countries.
They don't know the business well enough to push back.
Exactly. They don't have the institutional memory or the technical depth to push back effectively against a deeply entrenched founder who has been running the show since 1992.
And the research really screams about the missing pieces in the broader corporate narrative. For a company of this size, there is virtually no public data on their capital allocation strategy.
Which is concerning.
How does the board actually decide when to return cash to shareholders via a dividend versus when to pour hundreds of crores into building a new collection yard in Togo? We just don't know.
It's a black box.
There is absolutely no documented succession planning. What happens to this incredibly complex machine if Raja Agrawal decides to step down tomorrow? And there is zero clarity on how they handle related party transactions, which is always a massive red flag in founder-controlled companies operating in emerging markets.
When you put all those governance pieces together, it paints a picture of a highly successful, aggressively expanding, but fundamentally opaque, founder-driven machine.
Yeah.
I mean, you have to respect what they've built. The operational execution over the last 30 years in incredibly difficult markets is undeniable. But as they scale toward their massive Vision 2029 targets, and as they try to crack highly complex, technologically demanding markets like lithium-ion recycling, that lack of transparency and that lack of deep bench strength at the board level transitions from being a quirk of a founder-led company into a severe systemic risk.
It becomes a real liability.
You simply cannot run a massive, diversified, highly regulated global commodities and chemicals business like a family fiefdom forever. At some point very soon, their corporate governance has to mature to match their operational scale, or the whole thing could buckle under its own weight.
It's the classic transition problem that so many industrial giants face. Can the scrappy founder who brilliantly built an empire in the shadow economy successfully steward a transparent, heavily scrutinized global corporation? We will really have to see.
It will be fascinating to watch.
But let's take a moment to briefly recap this incredible journey we've been on today. Gravita is an absolute juggernaut. They are expertly riding the massive, unstoppable structural tailwinds of the global circular economy.
Truly unstoppable at this point.
They are brilliantly exploiting government mandates to kill off their informal competition, and they're printing an immense amount of cash from an old-school lead business while desperately trying to pivot their infrastructure to capture the metals of the future aluminum and lithium-ion. But as we've seen, they are balancing on a terrifying tightrope of unhedged commodity prices, severe geopolitical instability across their massive African footprint, negative cash flows, and highly questionable governance structures.
The execution risk they face over the next 5 years is immense, but the underlying reality of their industry is undeniable. The world has fundamentally changed. The era of limitless, cheap primary mining is over, and the era of mandatory, highly regulated recycling has arrived.
It's a new world.
And as we wrap up, that leaves me with one final, lingering question for you to mull over. Throughout this deep dive, we've seen how Gravita's current massive advantage is simply being the best at collecting the scrap from thousands of local touchpoints before anyone else can get it.
Right, their collection network.
But as the entire globe mandates recycling by law, the competition for that scrap is going to become as fierce as the historical geopolitical wars over oil.
Scrap is the new oil.
Exactly. Gravita is making a fortune acting as the middleman right now. But what happens to their incredible margins when the world's trash becomes so intrinsically valuable that the original manufacturers, the Teslas, the Xis, the Apples of the world, simply refuse to let it go in the first place?
Oh, wow.
What happens to Gravita when the megacorporations decide to close the loop entirely in-house and cut the middleman out forever?
That is the ultimate existential threat to their entire model. So the next time you drop off that dead car battery at the mechanic, or you see an old, crushed aluminum chassis rusting in a scrapyard, don't just see a pile of junk. You are looking at the highly contested foundational raw material of the next great industrial war. Thank you so much for joining us on this deep dive into the hidden world of Gravita India. Keep questioning the surface of the things around you, and we'll catch you on the next one.